Hi, it's good to have you back again. Today we will learn about certain special events which have the ability to push the stock price of an undervalued company closer to its absolute value. These so-called catalysts of value realization do not only allow you to profit faster, but also reduce risk, because they often lead to a shorter holding period and are therefore better to predict. Let's take a closer look. We'll start with a definition. A catalyst of value realization is any kind of event, actual or potential, that offers the opportunity for a full or partial realization of value in a stock within an accelerated timescale. The keywords are realization of value and accelerated timescale. It often takes up to several years before the stock price of an undervalued company starts to more accurately reflect the underlying business value. However, catalysts have the potential to push the price of a stock closer to its absolute value in a relatively short amount of time. This might still be a bit abstract, so let's make it more concrete. What kind of events are we actually talking about? Well, here are some common examples of catalysts: liquidation, spin-offs, buybacks, takeovers, addition to index, and lawsuits. You might not know what all of these are, but that is alright. I will very quickly walk you through each of them and explain how these events can speed up value realization. Liquidation. When a business is terminated or goes bankrupt, it liquidates, or in simpler terms, it sells everything it owns and then uses the money this generates to pay creditors and finally shareholders. The assets being sold during a liquidation might be closer to their absolute value, thus instantly closing the gap between price and value. Spin-offs. A company can have several products or services, but might want to focus on just one of them. In this case, they can split the company up into two individual companies. Shareholders then receive shares in both companies. These spin-offs tend to increase returns for shareholders because the independent companies can better focus on their specific products or services. However, spin-offs often underperform in the short run because shareholders of the parent company might not want to own stocks in the spin-off company and therefore try to get rid of them, which pushes prices down. Buybacks. Companies can buy their own shares to increase their level of ownership and protect themselves from hostile takeovers. However, they can also buy back to increase the value of the remaining shares. Because if a company has $1 million in earnings and 100,000 shares outstanding, the earnings per share are $10. However, if they repurchase half their shares, the earnings per share increases to $20, while their earnings remain the same. Therefore, buybacks are a catalyst of value realization. However, buybacks are only creating value if the company buys their shares at a discount to their absolute value. Buying back overpriced stocks actually destroys value for shareholders. Takeover. If one company wants to acquire another company, it can make a bid. This bid is usually significantly higher than the current stock price, thus immediately driving the price up, which is great if you happen to own that company. Be careful though, because if a company does not want to be taken over and declines the offer, the price will drop as quickly as it rose. Addition to an index. Index funds are investment funds which own stocks of all the companies in a certain index, like the S&P 500. Now, if a new company is added to the S&P 500, all of these index funds will have to buy it straight away. This results in increased demand for stocks which are added to an index, and this increase in demand can push up stock prices. Lawsuits and investigations. We'll end this list with a strange one. Companies are sometimes sued or placed under investigation for fraud or other malpractices. This bad news creates uncertainty. People tend to dislike uncertainty, and therefore this usually results in a significant price drop. However, being under investigation does not necessarily mean the company is actually guilty. So when the result of the lawsuit or investigation turns out to be positive, the stock price tends to jump back up quickly. So, now you know some of the most common events which can function as a catalyst of value realization. But how can you actually apply this information to your advantage? Well, most of these events are unpredictable, and therefore you should not base your entire investment strategy on them. However, you should take the possibility of these events happening into account when analyzing stocks to increase the odds of a favorable outcome. For example, if there is a general takeover trend in a certain industry, this increases the chances of small companies with viable products in a specific niche to be taken over. For many of these catalysts, it is simply a matter of following the news. You might be thinking now, but in earlier lessons you told me not to follow the news. Well, I said not to follow it too closely. One innovative way to filter out much of the garbage and only receive news about companies you are interested in and topics you are interested in is by setting up Google Alerts. If there's anything newsworthy, Google will know about it. Their alert service allows you to receive email updates related to the search queries you specify. To set up Google Alerts, go to alerts.google.com. Fill in a search query, for example, IBM lawsuit. Optionally, you can set some preferences, like how often you want to receive updates, and if you wish Google to search everything, or only videos, blogs, news, etc. Once you are done, press Create Alert, and Google will start sending you updates as soon as an article appears which is related to your keywords, in this case, IBM lawsuit. This allows you to stay on top of important information while not being overloaded by useless information which might cloud your judgment. Another great source of information regarding potential catalysts is the website of the Securities and Exchange Commission, or SEC. Every company listed on the stock exchange has to report to the SEC, so they are the most reliable source of financial information. When a company is about to liquidate its assets, or is planning a spin-off, they will have to report this to the SEC first. The SEC tool for searching through company filings is called EDGAR, which you can access at www.sec.gov/edgar.html. Be warned that this tool is not user-friendly at all, so it takes some getting used to. I recommend looking up some tutorials on how to use EDGAR effectively. So while the main focus of your investment strategy remains to buy great companies at discount prices, a catalyst simply makes such a company an even more attractive opportunity, because it has the potential to push up the price in a relatively short time span. Just keep in mind that there's never a guarantee that things will play out the way you expect. Let's quickly recap what we learned in today's lesson. A catalyst of value realization is an event which has the potential to close the gap between price and value in an accelerated timescale. Catalysts reduce risk because they often lead to shorter holding periods and therefore have outcomes which can be predicted with more certainty. Examples of catalysts are liquidations, spin-offs, buybacks, takeovers, additions to an index, lawsuits, and investigations. Each of these events has its own unique way of stimulating an upward price movement. Do not base your entire investment strategy on catalysts, but see them as a bonus. 2 ways to find out about catalysts are by setting up automatic email updates using Google Alerts and by reading through company filings on the SEC website. Buying great companies at discount prices should remain the main focus of your investment strategy. Even if a catalyst seems to exist, this is no guarantee that things will play out the way you expect. Now it is time to get a bit more practical. In the next lesson I explain exactly how you can calculate the absolute value of a stock.